The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. He's the Mac who still hasn't got a strike against his remuneration report. It's Anthony McDonald. How are you, Anthony?
James, not much to see in the REM report here, mate.
I doubt that. Well, this week we look at the mini-meltdown at Macquarie, the other Mac. We examine the pitch battles over who's going to manage your money. And we ask why Chinese cars are taking over the Australian market. But Anthony, let's get the bull dust out of the way first. That's good old American bull dust, of course. This week, Anthony Albanese opened the doors to US beef exports as a bit of an olive branch to Donald Trump and his threats of tariffs. Anthony, am I going to be buying Texas T-bones or Baltimore burgers in Coles anytime soon?
Please, God, no. We just don't need it, James. We got plenty of good beef farmers here. Hello, right. Uncle Mal. Hello, Uncle James.
Oh, okay.
we exported 1.34 million tonnes of beef last year. More than 1 million tonnes the year before that, the year before that, the year before that, etc. You know, our beef goes into Woolworths and Coles first and then into the export markets. So this isn't cheap stuff to transport perishable goods. You know, it's got a bit of weight behind it, need cold storage. We've got all the cuts, all the best breeds. Tell me, you're well-travelled. Like, have you had a better steak anywhere than Australia?
No, I don't think so. What gets me a bit, Anthony, is like a month ago, Albanese and Jim Chalmers were telling us, no, this is all about like biosecurity. We just couldn't let this beef in. We're sticking hard to this position. All of a sudden, we've rolled over. Like, what's going on?
Right, that's pretty important, the biosecurity.
Totally.
Obviously. I mean, we don't want mad cows here. I mean, that'd be disastrous for the industry. But, I don't know if they've worked out a way to overcome that or they're just overlooking it for symbolism reasons. And I think that's what this decision this week is, James. It's just symbolism because at the end of the day, like, I'm not sure why we'd be importing their beef. Like, what's the value proposition? Now, how can the US produce beef cheaper than us and get into Woolies and Coles cheaper than we can?
Yeah.
Maybe the processing bit's a bit cheaper over in the US, James, because, you know, our minimum wage is higher here than it is over in the US. But, mate, by the time you get it here, surely the Australian beef's going to be A, cheaper, and B,
totally.
You know, our farmers would argue better quality.
Yeah, I think 99% of the beef consumed in Australia is Australian. I can't see that percentage changing too much. But, Anthony, it's interesting. Like, we've had a big week of trade deals, and you can't see me, but I'm doing the big inverted commas around those trade deals because these things aren't deals. I mean, the one with Japan was amazing. Like, Trump comes out and says, you know, we've got a deal, it's a very good deal, and all that sort of stuff. Japan's agreed to drop the tariff on American cars from 0 to 0. And in return, they've copped, they've had their tariff reduced from 25% to 15%. Now, don't get me wrong, that is a big increase from the 2% tariff Japan faced on its imports at the start of the year. So this is sizable, but like the wheeling and dealing here is crazy. And to call these things deals, they are at best frameworks for future arrangements that one day might turn into deals. Trade deals take years. Sometimes they take decades. Like the idea that, you know, we're just banging these things out over a cup of coffee in a couple of weeks. Please spare me. It's just dribble.
Well said, James. Now, speaking of imports, we had a great piece this week from one of our new members of the team, Sam Irvine, down in Melbourne, who wrote that Chinese-made cars are expected to make up almost half of all cars sold in Australia by 2035, or 43% to be exact, up from 17% at present. Both those numbers really surprised me, James. I mean, do you believe them? Can Chinese cars dominate Australian roads?
Well, Anthony, I did the driveway test on this one, and I just sort of went around looking at the cars around my area. And when you sort of look at the very anecdotal numbers, you do see a lot more Chinese brands out there. There's a lot more BYD cars. Now, there's a recency bias in all this. You always, someone in your family buys a Toyota or a Mitsubishi, and the next 25 cars you see on the road are Toyotas or Mitsubishi. But it does feel to me like Chinese cars are a lot more prevalent on our streets, BYD particularly, but other brands like Chery, Great Wall. There's a hell of a lot of Great Wall utes around my area, so that's they've broken into that market very successfully, I would have thought. And it's not surprising, Anthony, because China is producing a hell of a lot of cars at the moment. They're producing so many cars that even the Chinese president last week said, "Hang on, why are we producing so many cars? Are we sort of getting into the sphere of irrational competition here?" So it's natural that some of those cars will find their way to Australia. We're a big car consuming nation. And given the price points of these Chinese cars, that's what's going to happen. I think the interesting thing in that article, I think from one of the head of the Dealers Association in Australia, he said, look, this is just the way the cycle goes, right, Anthony? We've had Japanese cars, we've had Korean cars. Generally, we see these different brands and we're better for it. That's just the way it'll go this time, right?
Yeah, for sure, James. I mean, I'm not lining up to buy a Chinese car today, tomorrow, or any time in the near future, but I'm one of those people that will want to see a few more of them on the road and get my head around it. But
yeah,
I love looking at the car numbers that come through every month, James, just to see what's selling and what's not. I mean, I'm not a petrol head by any stretch of the imagination, but I just think it's really interesting to see what people are buying.
Yep.
Year to date, 121,000 Toyotas have been sold, Japanese car. All right, that's that's like 2.5 times the next biggest brand, Mazda. And then goes Ford, Kia, Hyundai, Mitsubishi, and then a couple of Chinese brands, GWM and BYD.
Yeah.
Right? So the Chinese brands are already well ahead of the Europeans, your Volkswagens, your BMW, Mercedes-Benz. They are climbing up those rankings, but I think Toyota is still a long, long, long way in front.
Yeah, and I think the more cars you see, someone in your family or one of your friends has one of these cars and has a good experience, away you go. So the sort of changing face of the car industry is going to be very interesting to watch.
Okay, James, let's get to our first big story of the week. And on Thursday, investors gathered at Macquarie Group's stunning Sydney headquarters for the Millionaire Factory's annual general meeting. James, these events are pretty boring affairs, plenty of retiree and retail investors, a few activists unhappy about oil and gas investing, a few sausage rolls, and everything done in a few hours. But Thursday's meeting was a tense affair because word got around that Macquarie risked what's called a strike against its remuneration report. Essentially, that's a protest vote of 25% or more against. James, what were investors grumpy about?
Well, they weren't grumpy about the fact that the Millionaires Factory is the Millionaires Factory. Everyone knows that the men and women at Macquarie are amongst the smartest people in the collective room in Australia. They get paid a lot of money for generating a lot of value for the company and its shareholders. There's a famous sort of way of managing at Macquarie they call it the loose, tight management style, where everyone's given a lot of autonomy to go off and find opportunities and exploit those opportunities, but there's always strong accountability. And generally, investors like that, right? The staff get rich, but we get rich as well. That's the sort of bedrock of capitalism, and that pay structure is an important part of it. There's a lot of places that smart people can go and work in financial markets, and Macquarie needs to retain and incentivize them. No problems there. But if the problem that investors have got here is if you're going to use money as a giant carrot, you've got to use money as a stick. And so there needs to be really tight consequences. There needs to be consequences when something goes wrong. And at Macquarie, they've had a number of things go wrong around regulatory problems. So you'll remember back in May, ASIC took them to court over the misreporting of some share sales. That was just the latest in a sort of long line of things. ASIC's got a number of other issues with Macquarie at the moment, and then APRA, which is the Australian Prudential Regulatory Authority, way back in 2021, it whacked Macquarie with a $500 million capital overlay because of its poor risk management. Basically said, you guys need to carry an extra $500 million in capital because we're not completely convinced that you've got your risk management right. So those issues are bubbling away, right? Mm-hmm. And from the point of view of Macquarie investors, they want to see that the board has held the feet of management to the fire. And how do you do that at Macquarie? Through money. So there's got to be some consequences around pay. And what Macquarie investors are saying is, we don't feel there's enough of those consequences that we've seen yet. And that's become this really big issue. But Anthony, take us back a little bit. Why is it that Macquarie's pay structure is such a focus in the market? Obviously, their people get paid lots, but it's the way they get paid that really matters, right?
Yeah, and it's the bedrock of the Macquarie model, James. I mean, like, Macquarie is at its heart, it's a human capital business. It's about people. You know, its model's been like that for 30, 40 years. It's all about attracting the best and the brightest grads, give them plenty to work on, move them around, give them lots of experience, accelerate the best, pay them lots. You know, Macquarie pays 40 to 45% of the revenue it brings in out to staff as pay every year, which is not, to be fair to them, it's not out of line with other investment banks around the world, but it's massive in Australian context. Like, compared to a Commonwealth Bank or a Westpac or a NAB, you don't get anywhere near as that. So Macquarie pays its people a lot, which keeps them motivated. It's sort of like an eat what you kill model. The whole, internally there, the whole thing's set up around revenue, how much revenue you bring in, and hopefully then you see a big piece of that in your pay packet. So they pay you in cash and shares, James. I mean, the biggest shareholder group is the staff itself.
Yep.
I mean, that gives them alignment to shareholders, keeps them loyal to Macquarie, and you can accumulate a lot of stock. Like, if you look at the Macquarie annual report for the year just gone, Shamara Wickramanayake, she had 1.3 million ordinary shares in Macquarie. That's worth like $280 million worth of shares, James.
Nice.
Like, just imagine the dividends on that, let alone the upside. So those shares that they give you, I mean, the longer you stay there, the more you accumulate. That really gives you a big capital base for yourself, but it also makes you really expensive to poach as well, because a lot of those shares will be restricted, locked up for up to 7 years for the top execs. So it's really keeps you as part of the Macquarie family, keeps you sort of aligned with everyone else. So honestly, James, there's nothing more important than pay at Macquarie. Like, it is just so fundamental to that company's success. Which is why it's fascinating. We had this strike this week, James, and you broke a fascinating little story about just before the meeting that Shamara was calling around investors to try and calm them down and get this vote through. What's so interesting about this? I mean, she's the boss. Why shouldn't she call around?
Well, Anthony, there's a sort of pecking order when it comes to these things. Yes, she's the boss of Macquarie and unquestionably the star, perhaps one of the great CEOs in Australia. But as I say, there's a pecking order. And when it comes to matters of pay, that's the preserve of the board, and specifically the chairman, who in this case is a guy called Glenn Stevens, who you might remember used to be the governor of the Reserve Bank a while back. Mm-hmm. So when the CEO is calling around about pay, and they're invariably the highest paid person at the group, that tends to raise the eyebrows of investors. They're going, hang on, we were concerned to start with that the board wasn't whacking management enough about these regulatory problems. And now I've got the CEO on the phone telling me how important the pay structure is. That doesn't quite feel right. You know, Shamara says that she was just ringing around to test the temperature of investors, find out what their concerns were, and reinforce that the Macquarie model doesn't work without that pay model. And so you can sort of understand that logic, but I think, Anthony, this has left a few noses out of joint, hasn't it? In some ways, I think it's made the problem worse.
Created more of a governance issue, you think?
Or at least it's highlighted the governance issue that investors were worried about at the start. You know, if you get a call from Glenn Stevens and he rings you up and says, "This is Glenn Stevens, I hear you're upset, and let me tell you, I am listening, and we hear your concerns," then perhaps you go, oh, well, okay, the board's receptive. If you get a call from Shamara rather than Stevens, you're wondering, does Glenn quite get it? I know Shamara gets it, but does Glenn quite get it? He says he does. He had this great line at the AGM on Thursday that he might not have been very effective, but he wasn't asleep at the wheel.
Yeah.
So I'm sure that'll go down in the history of great AGM quotes. But Anthony, what happens from here? Like, the thing about a strike, a protest vote against a pay report, is in some ways it's it's embarrassing, but it doesn't matter.
No, that's not true. They matter.
I know, but technically it's what's called a non-binding vote, right? So you don't have, it doesn't actually lead to any consequences. But if you get a second strike, a second protest vote the next year, the board is required to consider a voluntary spill of the entire board, which would go from a minor embarrassment to a major one. So Glenn Stevens is not going to want to get anywhere near a second strike. So what happens now? How does he recover or react from this?
Well, first of all, I think you're underselling what a strike is, James. Like, honestly, it is a big deal. Like, like some companies, and there are a few out there, they are not the top blue chip companies. They will roll from AGM to AGM, get strike after strike after strike, and not worry. I mean, let's be honest. Investors are not about to spill the board of Macquarie over this issue right now.
That's exactly right.
It's not that, but it is such an important thing that they've got this strike. And I think the answer to what happens from here, it's pretty simple, but execution's the hard part. Like, nothing necessarily is wrong with the Macquarie model. Macquarie is where it is because of the model. The quantum of pay, their bankers are well paid. That's not what got them the strike here. Investors know it. They understand it. They get that bit. It's the regulatory issues, James, and Macquarie just needs to stop them. Like, we saw ASIC come after Macquarie 4 times, I think it was, in the past year. A couple of months ago, it was like bang, 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 a few in a row.
Yeah.
And that's just in Australia. Macquarie's obviously fighting other issues in other parts of the world, but that's what needs addressing, James. Like, at the core of it all, business is just a juggle. We talk about it a lot, between the balance between customers or clients, employees and shareholders, right? When Macquarie gets that right, everyone's making money, everyone's happy. When they're not, though, the regulator gets its back up and we get situations like we've got this year. So if you think longer term, what makes a Macquarie sustainable, you need the outcomes for those 3 groups to sort of blend together. And I'm not sure that you can order them and say that employees are more important than shareholders, are more important than customers. Like, you need the 3 all winning at the same time. That's what business is. But I think if you look after the customers and the employees, then your shareholders, they should be right. That's how you create long-term shareholder value. So the problem for Macquarie, obviously some of these issues go way back. Like, you brought up the short selling one. I mean, that's a 10-year plus issue. Macquarie's been working with the regulator on it for at least 5 years. It's had multiple chances to get it right. Still hasn't got it right, according to ASIC. So hence why it's getting sued. But I think it's abundantly clear that from the GFC, post-GFC issue, when investment banking changed and everyone got a lot more conscious of risk, which is a good thing, Macquarie's been very, very good at looking after its balance sheet, its own financial risk. However, some of this non-financial risk is a little bit lacking. Its measures around it, like, they just are. I mean, why else would we have repeated regulatory problems for them? So obviously Macquarie has to decide, look, are we serious about this non-financial risk management? And if we are, what are we doing about it? Is it enough? And I think the actions we've seen this year show it's not enough. So they got to pull their socks up.
Yeah. I think, Anthony, if you look at the history of Australian banking in recent times, I was going back over this after the Macquarie AGM. 2016, CBA got a pay strike. Yep. It was 2018 after the Royal Commission. NAB got a massive pay strike, one of the biggest ever. Westpac's had one. Not sure about ANZ, but my point is that they're like lines in the sand, right? They're moments where the bank has to change direction. Something has to give a little bit. And I think that's interesting. How much is going to give at Macquarie is my question, because they have a certain way of doing things, a model that's well established. I don't think they love change. They don't love the scrutiny from outside. So this is a moment, right?
Absolutely. So there'll be a review of the remuneration structure. I mean, there's a remuneration committee on the board, right? Gillian Broadbent, she's the chair, and there's 2 other directors on it. They'll go discuss it with shareholders, discuss it with proxy advisors, all that stuff. But I reckon the feedback, as you said right at the top, James, it's more about ramifications and penalties than it is about quantum of pay. And it's about these non-financial risks and putting them on a similar footing to the financial risks, because that's how the world is in 2025. You can't hide from that. And if you want to keep hiding from it, get ready for more strikes. And it strikes, if nothing else, incredibly bad look, right? Macquarie's an Australian global champion. We want it to be governance A grade, just like it is making money A grade, right? And part of that is evolving with the times.
Yeah, absolutely, Anthony. We'll watch what happens with interest. All right, for our second topic, let's pull together a few of the other big stories from the week. And on Tuesday, a US private equity firm called CC Capital signed a binding $3 billion deal to buy Australia's Insignia Financial, which owns the country's biggest retail superannuation fund. All of us would know this name, MLC. Also on Tuesday, news broke that industry super fund Host Plus, which is one of our 6 biggest funds, had formally moved to sack Lendlease as the manager of one of its property investment funds and replace Lendlease with Mirvac. Now, Anthony, these are 2 really different stories. One's a PE buyout, one's a fund manager getting sacked. But there is a string that connects them, I reckon. And dear listener, it is your money. Or more specifically, who gets to get rich from managing your money? Well, Anthony, we love the super sector. We're always talking about it here on the podcast. The super pool's worth $4.2 trillion, but managing that money has just become such a lucrative business. And where there's profits to be made, there's going to be great little fights like these ones that I just mentioned. Anthony, is there a stickier honeypot out there than collecting super investment fees?
Oh, this world of high finance, James, it's all about fees. It's clipping tickets, making money off other people's money. The super funds make money off the retirees. The asset managers make money off the super funds. The service providers like stockbrokers make money off the asset managers. And the whole world keeps spinning, James. And who pays for it all? I mean, ultimately, there's only one source of real money, James, and that's real people on the ground. People like you and I, everyone else that's listening. I mean, there's no money tree. There's no secret source. It's the same as the government when it runs a big budget deficit and has to borrow more to balance the books. Who's borrowing? It's the people, right? So in this one, it all leads back to the poor old super member, James. And super, like you said, it's fantastic, huge pool of capital. The best bit about it is having professionals invest their retirement savings for them that they wouldn't have had in the past. That's great. But the big bucket, it's a honeypot for fees. I mean, Rainmaker, which is a data group, James, they estimated the super sector paid $32 billion in fees in 2023. So that's a tick under 1% a year that everyone's paying in fees.
Wow.
Now, $32 billion. That's a lot of money. That pays for the super funds. It pays for a huge swathe of Australia's asset management industry, your property funds, infrastructure funds, private equity, etc. The $32 billion, what else do you get for $32 billion? That's 1.5% of GDP.
Yeah.
For context, we spend about 50 to 60 billion a year on defence, right? So it's almost like half that spending.
Yucks.
$32 billion, that's probably about the profit of the big 4 banks combined, James. Like it's a huge number.
I mean, that $32 billion, that was 2023, it's probably up towards, I don't know, 40 billion, 45 billion in 2025. But think about it, though. If you're sitting there over in New York or Zurich or some centre of high finance and you're thinking, geez, I wonder where we can make some investment fees. If only there was a place where the government forced you to save money and you know that the pool of savings is going to grow by 10, 12.5% every year. I wonder if we could get in. That's why we are inundated by these gurus of high finance. That's why the BlackRock guys and the KKR people, that's why they're down here every year. That they want a slice of the action, right?
100%. If you don't have an Australian office, like you'd open 10 of them tomorrow. Like it is that lucrative. Now, James, MLC was so good. We've got a relatively unknown private equity firm from New York coming in here for some of Australia's super fees. Now, this firm has never done a deal in Australia. It's not known to MLC's 850,000 members. It's not known to regulators. Is this a good deal or not for Australia?
Well, you got me worried. What else? What could go wrong? Look, I mean, the one thing I'll say for CC Capital, a guy called Chin Chu runs it, very sharp guy, a private equity deal maker. I think he spent 25 years at Blackstone, Anthony. I think he was like one of the original guys at Blackstone or close to it. They've been studying the Australian superannuation sector for 6 years, they reckon. So they know what they're on about. They know how it works. They've done sort of broadly similar deals in broadly similar areas overseas before. I think they know what they're getting. And I think what they see is an opportunity, particularly in retail super. Like you can see in super, we started off, 10 years ago, we might have had, I'm plucking a number here, but somewhere around 100 super funds. Probably in another 10 years, we'll be down to like 5 or 6 big industry funds and 5 or 6 big retail funds, and all the private equity players, everyone in the industry can see this, and they want to help lead the consolidation. So my sense is CC Capital does want to put some money to work here, does want to make MLC stronger. Scott Hartley, who's the CEO of Insignia, he said that the message is very clear that you only do well in this sector if members do well, and CC Capital gets that. So, look, is it a good thing that someone's coming with deep pockets that wants to invest in this business? Yep, I think that should generally be a good thing. But yeah, everything's got to be about the members. Like that's the inherent promise inside super. And as long as CC gets that, they should be fine. The one thing I'll say about them is they're not a traditional private equity fund in that they don't look to sell a business. They don't buy a business and look to offload it within 5 to 7 years. They have longer hold periods. They don't tend to invest via funds that have, have a deadline to return money to the ultimate investors. So hopefully they'll have a long-term focus too. But Anthony, tell us about this property fight between Lendlease and Mirvac. Is it a surprise to see Host Plus? They're not normally sort of an activist bomb chucker in corporate Australia. Is it a surprise to see them instigate this fight?
Yeah, totally a surprise, James. Like Host Plus, in my mind, they're big in venture capital in Australia, like big, like number one. They are the difference between a successful venture capital firm in Australia and not. They cut big checks. They've sort of underwritten that venture capital industry. But broader than that, we don't really see them as like a big sort of active player. We don't see them getting that many stoushes. But why is it doing? I mean, it's the biggest investor in one of these Lendlease funds, which is an industrial property fund. So that's warehouses and sheds, and more sophisticated versions of warehouses and sheds. It's just fed up about a lot of things that when you put them all together, it comes down to trust and confidence, and there's nothing more important in funds management game than that, James. So the investors in these 3 funds, they sort of got together and been considering options for a while. They're a bit unhappy with Lendlease, but been lots going on at Lendlease for a few years. So they had Mirvac come in and sort of put together a proposal to take over the management rights of these 3 funds. Yep. And they're trying to work out whether they'd be better off basically under Mirvac. I mean, some of these investors think they are, so it's time to pull the trigger. So to do that, they've got to call a meeting to vote Lendlease out. Now, Host Plus, the biggest investor, it's really stepped up. It's been the one that sent the letter, that pulled the trigger to try and get rid of Lendlease. From what I hear, it did it very reluctantly. It tried to call this meeting without naming itself, which is quite curious. So I think it's quite a reluctant activist. Yeah. But at the end of the day, I can't hide from the position that it's the biggest investor in this fund, and it's now leading the push. So time to step up. Host Plus. It'd be great to hear from Host Plus actually what it's actually thinking. I think that's another important part of this whole story. We need the people like the Host Pluses, your CC Capitals, to actually front up. Yeah. Yeah. So Lendlease has been investing money on behalf of super funds for years and years and years. Now it looks like it might be losing some of these funds. So it's a bad story for Lendlease. For Host Plus, though, I mean, it comes as it's just getting bigger and bigger and more active. I mean, it's a great example, James, of the super sector and how it's grown. Yeah. Like Host Plus has about $120 billion in assets, right? 10 years ago, it was $17.9 billion. So it's up 6 or 7 times in the past decade. Yeah. What a run. So with that comes experience, comes power, and hopefully with it comes sophistication as well. Hopefully they're better at what they're doing now than they were when they were a fraction of the size. So and perhaps standing up for yourself. I mean, perhaps that's part of it, right?
That's part of it, yeah.
I think we should prepare to see more of this sort of stuff. And James, I had a really good chat to Australian Super's Sean Manuel this week. He's the person in charge of its $97 billion Australian shares portfolio, biggest active investor in Australia. Now, he made a very important point, James, that he thinks that super funds, a lot of them are shirking their responsibility to actually be active capital allocators in Australia and back the best businesses because they're sending a lot of money to the passive funds and just investing based on size. Now, I was just wondering, I mean, what do you make of that argument? Do you think that super, the way it's using passive funds in the listed context on the ASX, do you think it's sort of shirking a responsibility to be, a good investor?
Oh, this is such a good question. I've been thinking about this, Anthony. I saw Sean's argument in your column, and I've been hasn't been quite keeping me up at night, but I've been wrestling with it because I'm attracted to what he says. I want superannuation to be thinking long term. You know, you got my money for 30, 40, 50 years. Please think in 30, 40, 50 year timeframes and make sensible capital allocation decisions that help make the country better over the next 30, 40, 50 years. Then I win, you win, our kids win, our grandkids win. How can you say no to that idea? The only problem is, who says that active management makes the right decisions? I mean, if we look at active management over the years, half of the active managers, generally, over the long term, fail to beat their benchmarks. So are they really great at actively managing money? And that's the point of superannuation, right? It's not to go off and chase productivity benefits or nation building stuff. It's to look after my retirement savings and make them grow. So if the more efficient way of doing that is through passive vehicles that charge a lot lower fees, that are a lot cheaper than active managers, you can sort of see the tension here. I really like Sean's idea, and I think broadly it's right, but I can see the tension. There are other super funds out there that basically just use passive investing vehicles because they're like, well, that's the way we get the best and most efficient return for investors, and that's what we're here for. So I don't know. I'm sitting on the fence here. I've got splinters, but I don't know. Where did you land?
I agree with you that active managers, a lot of them underperform the index at the end of the day. That's just a fact, right?
Yeah.
And once you add fees on top, the fees that they charge, they really underperform the index, and that's where the problem occurs. I think what Sean's arguing for is effectively cheap active management, right?
Yeah.
His team at Australian Super, no offense to him, I mean, I think they are taking a cheaper approach to active management. That's why Australian Super set up an in-house team. They're trying to do it more cheaply than what the usual active manager would do. So I think they're using that cheap active management. They think they can outperform the benchmark like that. But I think directionally, I quite agree with him, right? I think if you are a super fund, you can convince yourself that the returns from making active investment decisions are at least as good as the passive ones, then you can actually kill two birds with one stone.
Yeah.
You can make money for your members, and you can do the right thing by the country. And remember, James, super funds, surrounding this whole productivity discussion, super's been set up as this tax-effective sort of free ride, right? Wouldn't it be good if they were actually giving something back to the country as well, rather than just parking their money in passive funds?
Yeah. I think it's one where you can. I mean, we're not doing an ad here for Australian Super, but their Australian equity returns have been pretty good over the distance. So maybe there's a way to have the best of both worlds. All right. Well, we'll go to a break and we'll come back with what might be the most important bit of economic data for the year. Back in a sec. Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, the first sort of blush of reporting season arrives this week. On Monday, we've got the Australian Foundation Investment Company, which is our largest listed investment company, reporting. On Wednesday, we've got Rio Tinto reporting. They've just named a new CEO, as we said last week, so that'll be fascinating to watch. But look, the only thing that matters next week, Wednesday, 11:30, ABS, June quarter inflation data. Now, we've heard from Michelle Bullock this week, the Reserve Bank Governor, Anthony. Mm-hmm. She's looking at this. She's going to be watching this with eagle eyes. And I think that the whole economics function in Australia is expecting that if the trimmed mean for inflation, so that's inflation excluding volatile items like energy and fresh food, is below 2.7%, we're cutting rates, aren't we?
Feels like it, James. Funny though, I looked up. Survey says that it's going to be 2.7% as well. So what happens if it lands bang on 2.7?
Surely.
The last read was 2.9, so 2.7 is still lower than 2.9.
Yeah. There's no chance we're going to be surprised again. I felt a little hesitation in your answer about rate cuts there.
Mate, I just think I think the path we're on's okay, but wait and see.
Yeah. All right. Well, that'll be next week's big moment. But this week, we love questions here on the Chanticleer podcast, and our question is from Mike from New South Wales. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send in a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. And of course, the widget on all the Chanticleer articles at afr.com is another way you can get a question to us. Mike sent his question via the website, and he asks, how does the Trump pressure on Jerome Powell, the chairman of the Federal Reserve, compare to the Jim Chalmers pressure on Michelle Bullock at the RBA? Anthony, what do you reckon? It feels very different to me. I mean, we had this amazing thing on Thursday night where Donald Trump went and visited the Federal Reserve in Washington with poor old Jerome Powell on camera to inspect these renovations that the Fed's been doing, and basically sort of walk around and go, "Oh, I don't know about this, mate." It was incredible television. Now, we should say that the RBA's been doing a long and very expensive renovation too, but I haven't seen Jim Chalmers down there, pointing at cornices or looking at pipes and saying, "Oh, I don't know about this, Michelle." It's a bit different, isn't it?
I reckon Bullock's got about a tenth of the pressure, maybe 100th. Honestly, that's what are you referring to last night, James? That was astounding. The footage of it, literally Trump and Powell walking around in hard hats. I mean, so fitting,
good.
Particularly for Powell. And then Trump, like in front of the cameras, has just bombarded him with fresh information he's received about cost overruns of this renovation. Powell's like, don't know what you're talking about. And then Trump just like hands him over the latest costings and said, "Here, mate, have a read of this." And Powell has to get the glasses out and look at these costings, in front of the press gallery and the cameras. And just amazing. I mean, Chalmers, to be clear, I mean, he's doing pressure as well. And then the government has reshaped the RBA board. It's got some of their appointees on there. There was a split vote last meeting. Chalmers loved the fact that they disclosed the split vote. I mean, Chalmers is doing these press conferences in that 1 hour gap between the RBA decision and the RBA's press conference now as well. Like undisputedly pressure there, but no one applies pressure, I don't think, like Donald Trump.
Yeah, no, that's right. I think the other difference is what the two want. Like Chalmers would like to see rates come down a little bit. Trump every second day posts on social media that he'd like interest rates in America to be cut by 3%. Like, it's just wild. And what that would do to the credibility of the Fed, what that would do to inflation in America would just be wild. So, I think, Mike, it is important to recognise that all central banks face political pressure of some type. That they all value their independence, but their independence is always under a little bit of pressure. But I don't know about you, Anthony. I'd much rather be Bullock than Powell over the next month.
Totally.
All right. Well, Anthony, we'll be back to put, that said, we'll be back to put the RBA's next move under the microscope next week after we've got those inflation numbers. It's going to be a big day on Wednesday, isn't it? We'll look forward to breaking that down with you next week.
Absolutely. But I guarantee you Jim Chalmers will have more to say about it than us, James.
Absolutely. Thanks for listening. We'll see you next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald, and it was produced by Alex Gow and Mandy Coolin. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.